Hello, I'm Angeline Ong, and welcome to Beat the Street, the show that gives you all the tradable news and data you need ahead of the Wall Street Open. Just looking down there because we are waiting on data coming out any moment now. We are looking out for the housing and labor data after that stronger than expected retail sales figure, and also further signs that the U.S. labor market still remains resilient. Chips also in focus. Stocks on the move in that space after a solid outlook from TSMC. And oil prices eyed as the EIA raised its 2024 oil demand forecast, but lags OPEC's view. This is the IEA raising the 2024 oil demand forecast. Now, a very good afternoon to you. I'm Angeline Ong, and welcome to this new edition of Beat the Street. Let's get straight to the breaking news that we've been watching for you. First up, the building permits number. We were expecting 1.48. We got 1.495, so slightly higher than expected. In terms of the change month on month, 1.9% for the building permits. The change month on month change there for December. Initial jobless claims for the week ending 13th of January, looking out for 207,000. We got slightly less than that, 187,000. Just checking in on the volatility index, not much of a move there. We were at around 1516. It's now 1521. And just checking in on Wall Street for you, 37,213, slightly lower than prior to that number. Now, one of the key things that we've been seeing recently is that we are seeing a great recalibration between what markets expect the Fed to do, and also the Fed's messaging has been passed because we've had quite a few policymakers speaking recently, and perhaps much of the devil is in the detail. Well, joining me now is a very special guest from New York. John Stoltzfus joins us now from Oppenheimer. John, so good to have you on board with us. Thank you so much for waking up so early in the morning for us. Talk to us about recalibration and what you're hearing your side of the pond.
Well, thanks for having me on the show, Angeline, first off. Well, the recalibration that is occurring after a massive rally and lots of capitulation in the fourth quarter of last year by bears is a reassessment of things, of how that run-up, what was carrying that run-up, how much of it may have positioned the market slightly ahead of itself, we think. And now in a process of rebalance. First, we saw some profit-taking, some rebalancing, within portfolios as technology had gotten a larger share than many thought would be right for getting into this year. And of course, the idea that some corners of the market had related to thinking that the Fed could cut rates as much as 5 or 6 times. We've not been in that camp.
Now we're seeing this CME Fed Watch tool. We're seeing the percentage chance for this 25 basis point rate cut in March kind of easing. What is your view? I mean, is with inflation not really back, that genie back in the bottle, are we realistically going to see this rate cut in March?
Well, Angeline, we would think not. The Federal Reserve, in terms of Fed speak over the last few days has really gone from prospects of 3 cuts to at least one of the Fed presidents, regional presidents, I think said perhaps just 1 or 2, which when we heard that, we thought, gosh, that's what we were thinking. Inflation is a sticky thing to deal with. It is very troublesome to get rid of it once it gets placed into the system. And we don't think Jerome Powell wants to have to become a Paul Volcker and need to take draconian measures. And he certainly doesn't want to be an Arthur Burns, who was the predecessor to Paul Volcker, who failed to place inflation in check. So we think the Fed is going to guide expectations down. It's already started that, and it already has effectively done that to some extent. The market had a bit of a tantrum in here, and I think that was part of the profit taking and repositioning by aggressive investors who likely were highly leveraged. We can't help but think that the highly leveraged community is really trying to work to get the Fed to pivot. But we think the Fed is very reluctant to consider a pivot until it sees inflation really in check.
What kind of signals are you looking out for, John, that kind of will tell you, right, the Fed's going to cut, pretty soon? Is it a real weakening in the labor market? Is it, a real weakening in consumption? What are the signals you're watching?
Well, I think just from the numbers that we saw today related to housing and initial jobless claims, we'd have to say the economy is still showing very good resilience right now in the face of still, tight conditions relative to where we were when we had free money. That said, what we think that what we'll be looking for here is that the Fed is instead of taking the country into a recession, will be likely the Fed realizing that it is getting much closer or right on top of its goal of 2% inflation. And at that point, we'll say enough is enough. And rather than cutting rates because the country economy is in trouble, we'll rather cut rates maybe once or twice in the second half of the year because it sees an opportune time to do it.
So in the meantime, John, what's your view on stocks, at least in the first quarter? I know it's really hard given so many moving parts out there. And how about diversification and many of our clients out there who like trading tech? And the NASDAQ has had a strong run last year. I mean, what does one do with tech stocks whilst we're in this waiting pattern?
We've got to think, Angeline, that you still want to own technology, the big companies that are deeply embedded in the lives of both consumers and business, where we're all on the upgrade cycle, so to speak, and rely on those for greater efficiencies in business and greater comfort as consumers and ease of execution. We think that's important. But we also like consumer discretionary. We like industrials, and we would consider moving ahead that likely financials will improve. I should also add communication services, which is about 50% large cap tech, is a good one to hold, we believe.
Thanks very much, John. John Sulfus there from Oppenheimer Asset Management. Now, just a quick look at the dollar basket for you. Not much of a move after the key data points that we've just had a couple of minutes ago. Sean Murison has been looking at the dollar ahead of those numbers.
As markets start to digest the pace at which the US Federal Reserve will start to ease monetary policy or lower interest rates this year, the chart of the US dollar is showing a bit of a trend reversal, suggesting some dollar strength to follow. When we look at a chart here, we have this inverse head and shoulders pattern, which is just shaded gray, and that's suggesting that the short to medium term downtrend that has been in place could be moving into a short to medium term uptrend. We've had our upside break of that 102.45 level, and we are targeting a move to about 103.80 from that. Now, often when you do have a breakout, you could have a bit of a pullback before those gains are continued, but certainly the pattern is relevant and the pattern is in play. If we do start moving lower and closing below that 101.65 mark, then we could say that pattern has failed, and that the dollar could be renewing that longer-term weakness, which we have started to see from the end of 2023.
Now, in terms of corporates, it's all about chips. US-listed shares of Taiwan Semiconductor in focus after the chip makers' outlook lifted some of the other chip stocks, which I'm going to show you right now. NVIDIA, one of the all-session stocks that you can trade on the IG platform ahead of the cash open. It's currently ticking higher by around 2.7%. Also checking in on microchip technology. And actually, Intel's a good one to look at because it's all sessions as well. And Intel also currently up more than 2%. This is after the world's biggest contract semiconductor maker, TSMC, reported upbeat quarter profit and said it was looking at revenue growth of more than 20%. This is more than 20% revenue growth driven by demand for AI chips. Also checking in on the mega stocks for you, mega cap stocks like Microsoft, which just recently displaced Apple as the world's most valuable company. Microsoft also all sessions on the IG platform. It is up 0.3%. How about Tesla? Also all sessions, and that is also moving more than 2% higher. All this coming as US Treasury yields take lower. And let's take a look at oil now, because oil has got so much going on in this space, not just geopolitics, but also we had the IEA out with its latest forecast. It's raised demand growth projection by 180,000 barrels per day, and says that world supply growth this year is expected to exceed demand growth. IEA demand's forecast, it has to be said, remains lower than OPEC's outlook. Now, this is a quick look at US crude on the platform, and it is currently down 0.6%. Let's just have a look at Brent for you. Brent there also showing a similar percentage fall as we continue to watch what's happening over in the Middle East. Now, before we go, a quick last look at how the market is looking, and we are currently still in that narrow band. They're trying to break above that 37,680 or 37,740 mark. However, we are trading in this band, I guess, until we get further solid signs of where and when the Fed might cut interest rates. Until then, this is Beat the Street. For more analysis, do tune in to at Angeline Ong on Twitter or at IGCom. This is IGTV.